In this video, we're going to be discussing whether cash flow or capital growth is the way to build a property portfolio. There's no right or wrong answer here, so that's the short answer, but we're going to break down how I would exactly structure a property portfolio from starting from nothing to grow a large portfolio over time to give you financial freedom in the end. Drop a like on this video and subscribe to the channel down below, and head over to purposeproperty.com.au if you're looking for a Brisbane buyer's agent. Now, which one would you pick? Are you going for cash flow or are you going for capital growth? It all depends on what you're looking to achieve. But in an ideal world, I would typically start with capital growth and then move to cash flow over time. Now, why exactly would I do this? The reason is most people find it difficult to save the money for a deposit. So you need to start on focusing on capital growth to allow you to pull out equity, pull out your net worth, refinance your portfolio and your debt, and go and buy another investment property. One of the real secrets in investing in property here in Australia is that it's not just about the properties, it's really largely about the financial game around the property. Property is used as both shelter and a commodity here in Australia, and for me as an investor and a homeowner, I'm looking to add value to properties and hold them for the long term, have both capital growth and cash flow. So why do we start with capital growth? As I was saying, you're going to focus on properties that you can manufacture value, or you can also see strong demand in the short to mid term. You don't want a property that's going to have capital growth in say 10 or 20 years, because if you have to wait that long to actually realize that capital growth, you're not going to be able to refinance the debt, pull out equity and buy your next investment property. So really you're looking for short to mid-term gains in capital growth to allow you to pull out equity and start buying cash flow properties down the track. How can you exactly find a capital growth property to begin with? So you don't have any properties, you're looking to start your property investing journey. Now there's a couple of options here, depending on your risk profile and depending on how active or passive you want to be. Say you want to be an active investor and you've got a high risk tolerance. A great way to build capital growth and build your net worth would be to do property developments. Now, there's a whole range of property development types. You can do subdivisions, you can do new builds, you can do major structural renovations. Now, what Emily and I have done in our portfolio is lowered our risk profile a little bit and focused on manufactured value through renovation. This is not for everybody, and I totally understand that. Sometimes my renovation videos are less popular because you want to enjoy your weekends, you want to spend time with family, and you've also got your day job to think about. But this is a great way to fast track your journey. If you've got 6 to 8 weeks to spend on a project, working nights and working weekends while you keep your day job, then you can create a lot of wealth in a short period of time. It's a lot of hard work as well, but it's a great way to fast track your journey and make those capital gains in your property portfolio. So you're not waiting for the market to appreciate in value. You're going to manufacture that value by finding a rundown, ugly duckling. You're going to do some paint, some flooring, touch up the kitchens and bathrooms, and basically give the entire property a cosmetic lift. You're looking to double the money you spend in terms of value on the property. So say you spent $40,000 on that renovation, you want to add at least $80,000 worth of value to the property. So you bought a property for $500,000, you spent $40,000 on the renovation, you want the property to be revalued for at least $580,000, if not $600,000. So that's exactly how I would start my property portfolio if I was starting from scratch again. I'd be looking for properties that have manufactured value, whether I was willing to do the work myself, or if you're more passive, you can outsource these things to trades. So you can have a property manager manage the trades, get the carpenters in there, get the painters in there, have the kitchen cabinets refinished, new bench tops put in, and have the property cosmetically lifted to create value. The other option here is to find areas that are having a wave of capital growth in the short to mid term. So if you can buy in hot pockets in Brisbane that are riding a wave of growth, I know Hobart over the last few years has had a strong run of growth. Sydney, most of our major capital cities have had great growth, and regionals as well. Now, personally, I would be sticking to at least large regional cities, so I wouldn't be looking outside of the top 25 or 30 population centers. But if you can find areas that are having strong growth in the short to mid term, you can grow your net worth and then gain access to that equity over time. Once you've been able to create a bit of disparity between the debt and the value of your property, you'll have increased your equity holding in your portfolio. Now, at this point in time, I would look to move to cash flow. You can't live off capital growth in a property. It's just on paper. You can't go down and buy a loaf of bread or buy a coffee from McDonald's on your weekend with your net worth. So you need to have cash flow coming in to allow you to spend that money and potentially live on that money as well. Now, the way I like to think about it is you go for capital growth first, you then pull out some of that equity and you buy cash flow properties. There are a whole range of cash flow options as well. You can look at commercial real estate, which might be higher risk, but higher net return. You can look at multi-unit properties, so you can look at having a block of units or having multiple occupants in one dwelling, or you could look at lower cost properties, say a $400,000 property that rents for $400 a week, so that's roughly a 5.2% gross yield. So there's a range of options and risk profiles there. It depends on the level of capital you're able to access, but once you've got some net worth, then you can shift it into cash flow properties, maybe do house and granny flat as another option, and build out some of your cash flow to give you $1,000, $1,500, $2,000 a week of passive income. The most important part here is understanding your finances. If you don't understand the expenses associated with your property portfolio, whether there's land tax, rates, water, maintenance, property management fees, insurance, future taxes, you need to map all of that out and understand exactly what you're spending your money on. Otherwise, you might think you've got $2,000 of passive income a week, but if you have all those expenses taking money out of your pocket as well, your net cash flow might not be as good as you think. So again, it comes back to understanding your finances, and again, property being a game of finance. Financial literacy is something you can build over time. Look at other people's Google spreadsheets or Excel files, watch videos on YouTube, and gain an understanding of everything you need to assess as you build out your property portfolio. Now, there's no one strategy or no one size that fits all people. You might have a massive day job income, so capital growth properties might be the pick for you. You might be someone that's just starting out or on a lower income. You might only earn, say, $40,000 or $50,000 a year, and you might not be able to afford expensive blue chip properties. So starting with a cash flow property might make sense for you as well. For me, in an ideal world, I'd start with capital growth and then move to cash flow properties, but no one size fits all. You need to understand your income, your situation, your goals and dreams and aspirations, and where you want to be long term, and then map out your journey from there. Whether it's capital growth or cash flow, they both work in building out a property portfolio. It's about finding the right mix at the right time for your situation. Property investing has been quite hyped over the last few years, but it's very important to take a long-term perspective. If you're thinking this is going to happen in 2 to 3 to 5 years, it's very unlikely unless you're doing something that other people aren't. If you're replicating people who haven't actually achieved success in property investing or in building out a portfolio, then you're unlikely to be successful yourself. You need to try and mirror and see what other people are doing and how they became successful, and try and copy that. There's nothing wrong with seeing someone else's blueprint and then adjusting it to your own situation. We need to take an abundant mindset here. And all that simply means is a glass half full approach. We need to be positive when it comes to investing, that everyone can build wealth, everyone can put in some hard work and some effort, help lift each other up, and share their knowledge and their understanding as you go to build out a property portfolio. I hope you found value out of this video. Drop a like and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.